Holy smokes, everyone. Real estate investors and real estate hedge funds that have been buying up entire neighborhoods, they are starting to panic, watching the stock market crash, watching bonds crash, precious metals and cryptocurrencies, and they know it's just a matter of time, and they know they're next. In today's video, I'm going to go over the many reasons why that the housing market is the next market to crash. And it's not a matter of if, it's just a matter of when. And I think it's going to happen very, very soon. And these hedge funds that have brought up entire neighborhoods, they're going to get dealt instant karma. So everyone, what exactly is going to be the trigger for the housing market downturn? And how can we position ourselves to prepare for this event to either buy that dream home you've always wanted or to get that investment property on a discount? Well, that's exactly what we're going to discuss in today's video and much, much more important economic news. So let's not waste any time, ladies and gentlemen. Let's get straight into it. Okay, so I'm sure you've been seeing what's been happening in the stock market lately. The S&P 500 almost ended in a bear market. It fell 19%. The Nasdaq fell over 27%, and many stocks, or the high-flying growth tech stocks, are down over 50%. We've seen Bitcoin crash from $69,000 to $30,000. We've seen gold fall from nearly $2,100 down to $1,800. We've seen bonds in the TLT ETF fall 30%. And what is the final asset that hasn't fallen yet? That's right, real estate. But what exactly is going to be the first pin to pop the bubble? Let's have a deeper look. Well, the first pin to pop the bubble will be this, everyone. Look at this. The average US mortgage rate has now risen to 5.5%. I don't know about you, but it feels just like yesterday that mortgage rates were at 2.7%. So guess what? Mortgage rates are now double what they were from their lows in 2020. And what has fueled this crazy housing market bubble? Well, cheap debt and inflation. Inflation has been higher than the interest, and people have been taking on mountains and mountains of debt because it was just like free money with inflation, at 5 to 8%, and people could borrow at 2.7%. When you factor in inflation, it was like people almost getting paid to take on a mortgage. But with mortgage rates skyrocketing and the Federal Reserve saying there is not going to be a soft landing, and they're saying they're not going to stop until inflation gets back down to their 2% inflation target, this is all about to change. Now, what you have to know with the housing market is for every 1% increase in interest rates, people's borrowing power gets reduced by about 10%. So now we've had interest rates go up by nearly 3%. When the average 30-year fixed rate mortgage hits 5.7%, that will be a 3% increase. Add to that 50% price increases in houses, people are simply not going to be able to afford these homes. And guess what? These hedge funds that have been buying up these entire neighborhoods, they are going to stop once they see there's no more returns. And if they do keep buying and they start having losses, guess what? Their shareholders are going to want them to stop buying. And they may even start to hit the panic sell button. And this is happening now, people. Home buyers facing high prices, unexpected cancelled contracts in new home builds. Now, what's been happening is maybe people sign a contract to build a home 2 years before it actually be finished, or a year before, when what's happened in the past year, mortgage rates have skyrocketed. So maybe they could afford the mortgage when interest rates were at 3%, but now that mortgage rates are 5.5%, they simply can't afford these new homes that they're going to build. And there's going to be a lot more cancelled contracts coming. And this couldn't happen at a worse time, because remember, another reason why we've had this crazy housing market is because there's been no supply, especially because they cancelled foreclosures, they cancelled evictions, but guess what? Foreclosures are back and they are surging. And guess what? Also evictions are back. So this is going to add more supply to the housing market right when contracts are being cancelled by builders, and there's been a lot more building activity happening. Yes, it hasn't been enough to keep up with demand, but when people start to sell, when eventually these new builds do come onto the market, this is going to add more supply and more downward pressure on prices. But you want to know something that's really worrying right now? Well, this is a new trend that, like what we saw in 2008, adjustable rate mortgages are coming back, and people are piling on mountains of debt at low interest rates. But once they go to 6 or 7% after the adjusted rate period, guess what? They're not going to be able to afford it. Look at this. Adjustable rate mortgage demand surges to 14-year high as home buyers try to afford this pricey spring market. And the share of adjustable rate mortgages increased to 11% of overall loans and to 19% by dollar volume. People, this is going to be an absolute disaster. And you know the saying, history doesn't always repeat, but it often rhymes. And everything that I saw that's happening in 2008, I'm starting to see this now. And these new adjustable mortgage rate mortgages are starting to sound a lot like 2008. Now, the housing market takes a dive. That's bad news for anyone using it to diversify their portfolio. But if you've been paying attention to my channel, you would have heard of something that can be a great diversifier and an inflation hedge during this crazy inflationary period. I'm talking about investing in art. Fine art. From the big shots like Picasso, Banksy, and Basquiat. I know it sounds crazy, but let me tell you why I think it is a good idea. Because unlike a lot of digital art pieces like NFTs, this is real tangible art and is a real tangible asset. And during times of high inflation, it resists inflation remarkably well. And fine art has been used as a store of wealth for billionaires for centuries. But unfortunately, over the centuries, it's been very, very hard for the average Joe and Jane to invest in fine art. Well, that's where today's video sponsor, Masterworks, comes in and solves this problem through innovation. And not only that, it's been outpacing the S&P 500 for the past 26 years by a massive 164%. Because think about it, this market is fueled by the ultra rich. The people who get richer during times of crisis. So this market normally does still deliver even during times of crisis, like what we saw during the COVID pandemic. And with inflation now at 8%, you're definitely going to want an asset that is outpacing inflation. And fine art, well, this has had a price appreciation of 23%. Now, I have to say, past performance is no guarantee of future performance, but like I said earlier in the video, history doesn't always repeat, but it often rhymes. And again, there's been no way for retail investors to invest in art, but there's no better way than investing with Masterworks. How it works is they let members collectively invest in works they buy. And demand is so high that there's actually a wait list. But because demand was so high from my previous video, they want to give you priority access to skip this wait list. So check the link in the description and the pinned comment to start diversifying today. Thanks for Masterworks for sponsoring this video. Now, back to the content. Now, what a lot of people will say is, well, I've got my mortgage fixed for 30 years. I'm not going to sell my home, so it's not going to affect my home value. Well, people, unfortunately, it doesn't work like that. What could happen is you could have a whole street that, for example, don't sell their home, but if there is one house on the street that sells, for example, at a 20% loss, that can affect all the homes on that street's valuation, especially when a valuator comes to value their home, they'll look at previous sales in the street. If they see there's this house that's been sold and it's 20% below what you're saying your home is worth, this can affect your valuation. Now, I just want to reiterate, the US isn't just one housing market, okay? There's many states, and in each state, they have their own capital cities, their own suburbs. So while I am warning there is going to be an overall housing market downturn in the US, there may still be some areas that will increase, especially we're seeing in areas like Florida, Phoenix right now, house prices have been surging, but there may be some other areas that could fall more aggressively. But I know what you're probably wondering, what is the biggest risk of fall for the housing market right now? Well, what has been causing all the worry in the markets right now, everyone? That is rising interest rates by the Federal Reserve. So in order for us to know if things are going to get worse, we have to pay close attention to what the Federal Reserve is saying. And guess what? This past week, they've come out with some statements and they are very worrying. Listen to this. So remember everyone saying, don't worry, the Federal Reserve will save the markets? Well, people, it's looking like they're going to keep crashing the markets. Powell says he can't guarantee a soft landing as the Fed looks to control inflation. And people, what a joke this is. Remember the Federal Reserve was saying, look, don't worry guys, there is not going to be, a crash. There's going to be a soft landing. Everything's going to be okay. Well, people, I still don't know why people listen to the things that the central bankers say, because it seems like every month they change their tune. Things are getting so bad with inflation, they can't hide it anymore, and they're about to get much more aggressive. And what would happen to the housing market if interest rates went to 8%? Well, we'd see an absolutely catastrophic crash of minimum 40%. But like I said, we need to keep monitoring to see if they will stop, because remember, everyone keeps saying, well, don't worry, they'll just go to 2.5% and pause. Well, what if they go to 2.5% and inflation is still stubbornly high? I don't think there's any way they can fight 8.5% inflation with 2.5% interest rates. Like the most recent time, Paul Volcker, when he had to fight inflation, he had to lift interest rates above inflation rate to get it under control. So Fed Chair Jerome Powell cautions Thursday that getting inflation under control won't be easy. Well, yeah, he's been trying for 2 years, so I guess it's not too easy, especially when you want to keep the markets propped up. So Powell also said he understands the added pain that higher rates may cause, but the Fed needs to act aggressively. Whoa, people, this is a very different Jerome Powell. Maybe it's because he secured his second term. So he's like, yeah, I've got my second term secured. Yeah, we can start jacking interest rates up now. It doesn't matter what's happening now. I've got my $1 million pay bracket locked in. And I don't know if you remember, but last year there was a lot of Federal Reserve chairs selling stocks right at the peak. But there's something huge people are missing. They're all talking about what the Federal Reserve is going to do with interest rates. But remember, the Federal Reserve has accrued a balance sheet of $9 trillion of mortgage-backed securities and US Treasuries. So even if they don't lift interest rates to 8%, what is going to happen when they start in June? So next month, they're going to start selling hundreds of billions of dollars of mortgage-backed securities. Guess what, everyone? That is going to make mortgage rates skyrocket, and this is going to put huge pressure on the housing market, and it will cause a housing market crash. And again, even if they don't lift the federal funds rate, when they start selling off the 10-year US Treasury yield on their balance sheet, that is going to cause bonds to increase, and mortgage rates are very correlated with what the 10-year US Treasury yield does. But people, that's not all. There is also a very new worrying trend that's happening in the economy right now, along with rising interest rates, rising costs. This is going to be the final nail in the coffin that could possibly lead us into not just a recession, but a depression. What is that, everyone? I'm starting to see companies put out very, very weak revenue growth, profit margins, and layoffs are coming. Look at this. Netflix lays off 150 members as the streaming service contends with big subscriber losses. But that's not all, everyone. Recessions loom, but the markets haven't got the message. So even though we've seen this big sell-off in the stock market, and remember, a lot of people would have been using their stocks and cryptocurrencies as a down payment for their home or a home they're saving up for, guess what? All their gains have been wiped out, so they're not going to be able to use their stocks, their cryptocurrencies, to buy homes like they could when they made huge gains in 2020 and 2021. So I think a recession is very likely, and you want more proof? Look at this. Walmart reports big earnings miss as higher costs and supply chain eat into their profits. And people, this is huge because Walmart is the biggest retailer in the US. So if Walmart is hurting, guess what? The whole country is hurting. And remember how they said all these supply chain issues will get better and it won't affect companies' profits? Well, it looks like it definitely is, and it's going to continue. And how did their stock perform yesterday? Well, not good at all, people. It collapsed 11% in a day. And remember, this is a blue chip company, not some penny stock. But the pain keeps coming. Look what just happened today. Want more proof that we're facing recession? Target Profit is hit hard by higher costs, inventory problems, and markdowns. And look what's happening to their stock in after hours. That's right, it's down 24%. So people, to put it in very, very simple terms, because I want everyone to notice, even people that aren't up to date with the latest and what's happening with all this new economic jargon, what this means in simple terms is interest rates is going up. All these hedge funds have brought up these entire neighborhoods once they realize there's no more gains to come, and their investors start to tell them to start selling because they don't want to lose, their stock portfolio. Foreclosures are coming back. New construction is going to hit the market. People are canceling contracts. That's going to add more supply. And the Federal Reserve is going to keep on lifting interest rates, taking us into a recession right when layoffs are coming and companies' earnings are collapsing. And people, this could be the recipe for not just a recession, like I said, but for a depression. But everyone, that's just my thoughts and opinions on the housing market. What do you think? What are you seeing in your local areas? Let me know down below. Again, if you want to start diversifying your portfolio with Masterworks, I'll put that link in the description and a pinned comment. Thanks for watching. I'll see you all in the next video.